Okay, let us start with IFRS 15 revenue from contract with customers. Okay, uh, first thing first, um, what is the core principle behind revenue? Okay, so revenue is recognized when control of goods, service is transferred to the customer at an amount that reflects the consideration the entity expects to be entitled to, right? So revenue is recognized when control of goods, services is transferred to the customer at an amount that reflects the consideration the entity expects to be entitled to, right? So, revenue, to recognize the revenue, we have to follow the five-step revenue recognition model. So, the five-step model, the five-step model. Number one, identify the contract with customer. Number two, uh, identify separate performance. So identify the contract with customers. Here the question is, do we have a valid contract? Okay. Number two, the step two is identify separate performance obligation. Identify separate performance obligations. Okay. Um, Here the question is, what promises must we fulfill? The third question is determine the third step is determine the transaction price. Determine the transaction price. Okay. That means how much consideration will we receive? And number four, step four is allocate the transaction price. That here the question is how much relates to each of the obligation. And finally, step number five, recognize revenue. Okay. So here, with the aspect of the exam, always remember, first thing is look at the contract, then obligations, then price, then allocation, and then recognition. Okay. So the key trigger for the revenue recognition is transfer of control, not simply the receipt of cash or the issuance of an invoice. Okay. So far, so good. And I hope you get it till here. Now, let us look at the step one, that is identify the contract with customer. Step one, identify the contract with customer. Okay. Uh, what is contract? A contract is it is an agreement between two or more parties that creates uh, an enforceable rights and obligations. Rights and obligations. Okay. Now, who is the customer? Okay, the customer is the one, a party that obtains goods or services, obtains goods or services from an entity, ordinary activities in exchange for consideration. Okay, what is the contract criteria? So, the contract criteria, parties have approved the contract, either written, oral, or customary practice. Parties have approved the contract. Okay. Number two, rights identified. That means each party rights regarding the goods or services can be identified. So each party rights regarding the goods, services can be identified. Number three, payment terms can be identified. Uh, Number four, the contract is expected to. Number four is the commercial substance. That is, contract is expected to change the risk, timing, or amount of future cash flows, timing or amount of future cash flows. Okay. Uh, and the lastly is it is probable that the entity will collect the consideration to which it is to which it is entitled. So remember that criteria are assessed at the contract inception. If criteria are met, generally do not reassess unless there is a significant change in the circumstances, or if criteria are not met, continue reassessing until the criteria are satisfied. So then we will get what our step two. What is the step two? Uh, Identify the performance obligation. Identify performance obligations. Okay. So what is performance obligation? A performance obligation is a promise to transfer to the customer. A performance obligation is a promise to transfer to customer either a distinct good or service, a bundle or bundle, right? Or a service or a series of substantially similar goods services transferred in the same way. In same way, right? So if goods or services are not distinct, they are combined into one performance obligation. Okay, what I just said. If if goods or services are not distinct, they are combined into one performance obligation. Okay, so far so good. Now the question is when is a good or service is distinct? When is good or service is distinct? Okay, the second. So, yes, a good or service is distinct. The second, the system is hanging a bit. Don't do this to me. Uh, okay. So, when is good or service is distinct? Spend its okay. It is distinct when both conditions must be to both conditions need to be met for this, right? Both conditions must be met. Number one, customers can benefit from the good or good service on its own or with available resources. Available resources. The promise is separately identifiable from other promises in the contract. So, what are the indicators of separately identifiable? Indicators of separately identifiable. Okay. Number one, uh, is not integrated with other goods or services, with other good services, and does not significantly modify one. It is not integrated with other goods or services, does not significantly modify modify or customize, another good service, does not highly depend on, highly depend on or relate to, other promise, other promise goods, service, right? For example, we have one example of construction, right? When we construct or build a residential unit, right, like this. Okay, so what it requires, it includes what it includes. It includes procurement. It includes construction. It includes piping. It includes wiring, right? It includes installation. It includes finishing, right? Although the individual goods or services can be distinguished, they are not distinct because they are integrated into one combined output that is a complete unit, right? So one performance obligation, that is a construction of the unit. So what is it? One performance obligation, that is what? Uh, construction of unit. Construction of unit, isn't it? I hope it is clear to you. Uh, if you need another example, let me give it to you. That is example two. Software contract. See, the software contract includes a software contract includes number one, software license, uh, installation, uh, software updates, technical support. So the software is functional without the updates or the support, and installation does not modify the software. Each component can provide benefits separately and is separately identifiable. So four separate performance obligations are over there, right? These are all what? Four separate performance obligations. Yeah. So in this case, you know, distinct is equal to customer can benefit, right? Plus separately identifiable. Separately identifiable. Let me shorten it. Okay. Distinct is equal to customer can benefit plus separately identifiable. Okay. So if not distinct, combined with other goods or services into one performance obligation. So far, so good. Let us move on. And the third step we have after it. And the third step we have after it. That is step three. Determine the transaction price. So transaction price. What is transaction price? Is equal to amount of consideration, the entity expects to be entitled to for transferring goods, services to the customer. Okay. Amounts collected on behalf of third parties is always will be exclude. So exclude amount collected on behalf of third party. For example, sales tax. Okay. So what are the factors to consider when determining the transaction price? Factors to consider are number one, uh, variable consideration. Number two, significant financing component. Non-cash consideration. Number four, consideration payable to the customer. Okay, so consideration payable to customer is normally consideration pay or payable to customer is a reduction in transaction price. Okay, and in exceptional cases, payment for goods or services received from the customer, it is not deducted from revenue. Okay, so what is consideration payable to customer? Consideration payable to customer. As I just said, it is a reduction in the transaction price. A reduction in transaction price. For example, you can say discount. Okay, it is discount, though we have an exception. And what's that? Returns from customer is not not deducted from revenue because those are the sale returns, right? So now, next thing which we have to learn is what is significant financing component. Significant financing component. Okay, a financing component exists. A financing component exists when the timing of payment provides a significant financing benefit because payment occurs substantially before or after the performance obligation is satisfied. Okay, so payment in advance. First thing, payment in advance. where here customer pays, okay, and entity is finance. In this case, cash received initially is less than the eventual transaction price. Okay, and recognize revenue, oh, sorry, recognize interest expense expense over the financing period. Okay, then we have payment in arrears. Payment in arrears. Well, in case of payment in arrears, entity provides financing to customer and cash received is more than the transaction price. More than the transaction price, or you can and um, recognize interest income over the financing period. Recognize interest income over the financing period. Interest element is recognized separately from revenue in operating category of profit or loss. Okay, it will be recorded in the operating category of profit or loss separately. So the interest element is recognized separately, right, in the operating category of profit or loss. Then let us look at the example. Okay, ABC receives dollar 840,000 1 year before delivering a machine, and the interest rate is 8%. So 8%. So interest expense dollar 840,000 into 8%, we will get dollar 67,200. Now, what will be the transaction price at delivery? Transaction price at delivery dollar 840,000 plus dollar 67,200 will get it will be 907,200. So at receipt of cash, it will be bank debit dollar 840,000 and contract liability credit dollar 840,000. Over the year, interest expense debit dollar 67,200 and contract liability credit dollar 67,200. Okay. When the performance obligation is satisfied, so on performance obligation satisfied, it is contract liability, debit dollar 907,200 and revenue credit dollar 907,200. So far, so good. And now let us look at the another example. Okay, on 1st January 2005, SDF sold furniture to customer for $4,000 with 3 years interest-free credit. Right, the customer took delivery of the furniture on 1st January 2005. Okay, the $4,000 is payable to SDF on 31st December 2007. Appropriate discount rate is 8%. The requirement is determine transaction price for the sale of the furniture and calculate the interest income to be recognized over 3 years. Okay, so here it is, the solution for you folks. What we will do, see, uh, the transaction price is how much? 4,000. Interest rate is 8%, so 1 divided by 1.08, power 2, power 3 years, it is for the 3 years, right? So what we will get the present value of 3,175. Because the financing component must be considered when determining the transaction price, interest income will also be recognized as follows. Firstly, 2000x5 $3,175 into 8%, we will get 254. And the next year, 2000x6, it's 3,175 plus 254 multiply by 8%, we will get how much? Dollar 274. And the next year, 2000 x7, 3,175 plus 254 plus 274. We will get into 8%. We will get how much? Dollar 297. Okay. So far, so good. And I hope it is clear till here. Let us move on. Next thing which we will look into is non-cash and variable consideration. Non-cash and variable consideration. So when consideration is received in a form other than cash, when consideration is received in form other than cash, first thing first, measure it at its fair value. At its fair value. Number two, its fair value cannot be reliably estimated. Use the standalone selling price of the goods or services provided. If fair value cannot be reliably measured, right, then use standalone selling price of the goods, service provided. So non-cash consideration is fair value. If unavailable, if unavailable, then use stand alone selling price. So far, so good. And I hope it is clear to you guys still here. Now, what is variable consideration? What is variable consideration? Variable consideration arises when the amount of consideration arises when amount of consideration depends on future events. Future events. For example, well, what are the examples? Discounts, rebates, performance bonuses, penalties, other contingent amounts. Okay, so far, so good. So, what's the revenue recognition rule over here? Revenue recognition rule. Okay, variable consideration is included. Is included in the transaction price only when it is highly probable that a significant reversal of revenue will not occur when the uncertainty is resolved. When the uncertainty is resolved. So far, so good. So, in this case, highly probable, no significant reversal, include variable consideration. Include variable consideration, right? For example, performance bonus. Example, performance bonus. Now, for example, the contract price is $9.8 million. Performance bonus is $0.5 million if completed within 5 months. Okay. Now, now company will consider the factors. The company will consider the factors. What are the factors? They will consider the factors such as, uh, availability of material and labor. Okay. Weather conditions, and most important, what is that? Past experience. Past experience. Past experience uh, with similar contracts. So in that case, if highly probable, bonus earned, otherwise, uh, and the transaction price will be equal to $10.3 million. If not, if not, then transaction price will equal to 9.8 million. So if performance obligation is satisfied over time, the appropriate transaction price is recognized as revenue progressively as construction takes place. So remember in this case that a variable consideration is included only when the significant revenue reversal is highly unlikely. Think bonus likely plus no significant reversal included. If bonus is uncertain, exclude until sufficiently certain. Right? So far, so good. And we are done with the step one, step two, step three. Now we will look at what the step number four. What is the step number four? Allocate the transaction price. Allocate the transaction price. Step four, allocate transaction price. So allocation principle firstly. Allocation principle. The the transaction price, okay, the transaction price is allocated to each separate performance obligation based on its relative standalone selling price. Okay. Now, what is standalone selling price? Stand alone selling price means price at which entity sell promise good or service separately to customer. Okay. Now, how we will how to allocate? The next question is how to allocate, right? So it will be, transaction price multiply by total standalone selling price of all obligations of all obligations. I hope it is clear till here. Now, what will be the timing of allocation? So, timing of allocation. Uh, Allocation is performed at the beginning of contract and subsequent changes in standalone selling prices and standalone selling prices do not change the original allocation. So remember, transaction price that is relative standalone selling price and then allocate to each performance obligation, right? So far, so good. Uh, Let me what I just said. Okay, it is transaction price relative standalone selling price and allocate to each performance obligation. Okay. So do not allocate based simply on the prices stated in the contract. Use the relative standalone selling prices. And I hope it is clear till here. All right. Now let us look at the activity two. Okay. Jason enters into a contract with a customer to transfer a software license, uh, perform installation, and provide software updates and technical support for 5 years in exchange for $240,000. Okay. Uh, J- Jackson has predetermined that each good or service is a separate performance obligation. Jackson sells the license installation updates and technical support separately. So each has a directly observable standalone selling price, that is software license installation service, software update, technical support. Now the requirement is to allocate the $240,000 transaction price to the four performance obligations. Right? So far, so good. Now let us solve this example. Well, see, firstly, what we have, software license, 240 multiplied by 150 divided by 300, we will get 120. Installation service, 240 multiplied by 60 divided by 300, we will get how much? 48. And software update, uh, 240 multiplied by 40 divided by how much? 300. But we will get 32. Okay. Then we have technical support. So technical support 240 multiplied by 50 divided by 300. How much we will get? 40. So total is 240. It is not observable. Suitable methods for estimating the standalone selling price might include, an adjusted market price, a competitor's price, or an expected cost plus margin. So far, so good, and I hope it is clear till here to you guys. Now we will look at to the we will look at to the fifth stage or fifth step, that is step five, recognize revenue. So revenue is recognized when or as performance obligation is satisfied. Revenue is recognized when or as a performance obligation is satisfied. Performance obligation is satisfied when the customer obtain controls of the promised goods or service. We already know that. So revenue may therefore be recognized. Revenue may therefore be recognized at a point in time or over time, right? For example, mobile phone contract. Uh, the phone provide a phone with a 2-year telecom contract. Okay. Monthly payment is $30. Contract period is 24 months. Total transaction price, $720. Phone stand alone selling price is $250. Telecom service, $576. So far, so good. So total stand alone selling price is $826. Now, see the performance we have to look at performance obligation, allocation, and revenue. Okay. The phone price, firstly, phone allocation is $720 multiplied by 250 divided by 826. So how much it is? 218. Okay. Then we have telecom service, $720 multiplied by 576 divided by 826. How much it is? 502, 502. And finally, the total is $720. So in case of, as far as the revenue recognition is concerned, revenue recognition is concerned, uh, recognize dollar 218 immediately when customer obtain the control of phone, the control of phone, okay, while as far as the you know telephone service is concerned, or telecom service, by the way, tele telecom service is concerned, um, recognize dollar 502 over 24 months as the service is provided monthly service revenue is dollar 502 divided by 24 months. We will get 20.92 per month. Okay. So revenue follows control, not cash received, and point in time recognized when control transfers. Over time, recognized progressively as the performance obligation is satisfied. Okay. Now, the next thing is performance obligation. Satisfied over time. So revenue is recognized over time when any one of the following of the following three criteria is satisfied. Okay. Uh, number one, number one, customer simultaneously receive and consume benefits like uh, the customer receives and consumes the benefits as the entity performs, receive, and consume benefits as entity performs. For example, cleaning services, cleaning services, monthly payroll processing. uh, routine maintenance services. Okay. Number two, customer control the asset during creation. Okay. Uh, so this is very simple. That is, the entity creates or enhances an asset that the customer controls as it is created or enhanced. Then number three, no alternative use plus right to payment. The asset created has no alternative use to the entity, alternative use to the entity. The entity has an enforceable right to payment for performance completed to for performance completed to date. Example, customized construction project designed specifically for a customer. Okay. So remember, over time, one of three criteria: consume, control, no alternative use, and right to payment will be there, right? If none of these criteria is satisfied, revenue is generally recognized at a point in time when control is transferred, right? So remember one thing: over time, that means one of three criteria, that is consume, control, no alternative use, and right to payment. Okay. If none of the criteria is satisfied, revenue is generally recognized at a point in time when control transfers. Now, next thing, performance obligation. Satisfied point in time. Okay. So if a performance obligation does not meet the criteria, for overtime recognition, it is satisfied at a point in time. Revenue is recognized when the customer obtains control of the asset. Now, what are the indicators of transfer of control? Indicators of transfer of control. Hmm. Customer has an obligation to pay, has an obligation to pay. Customer has legal title, physical possession has transferred, has transferred. Okay, so far so good. So physical possession has transferred. Customer bears the significant risk and rewards of ownership. Customer bears the significant risks and rewards of ownership. And finally, customer has accepted the asset. So these are the indicators and not necessarily all are the requirements. So far, so good. So now we have an example. One example is example one, that is construction over time. Construction over time. See, uh, T constructs specific residential unit. So unit cannot be directed to another customer, cannot be redirected to other customer, right? Therefore, no alternative use. Okay. In this case, uh, T has right to payment for work completed to date. Work completed to date. Second one is revenue recognized. So in this case, revenue recognized over time. Example two, construction point in time. So now here, another unit has refundable deposit on signing. Remaining payment due on completion. Okay. If customer defaults, T can only retain the deposit So in this case, T does not receive benefits as construction occurs, as construction occurs. One, two, do not have control of the asset. Transferred to the customer during construction, has no enforceable right to payment for work completed to date. So in this case, revenue recognized at a point in time when control transfers. So in this case, remember no overtime criteria. Okay. Point in time and identify when control transfers. So for construction questions, focus particularly on alternative views, right to payment for work completed to date. That's a tip for you, right? Uh, I hope it is clear till here, and you enjoying the IFRS 15 so far. That's my hope, right? So measuring progress towards completion. Now remember that When a performance obligation is satisfied over time, revenue is recognized based on the progress towards completion. So the question is when can revenue be recognized? Revenue can be recognized over time when the progress towards completion can be reasonably measured or progress cannot be reasonably measured. Measured but costs incurred are expected to be recoverable. Now, what are the methods of measuring progress? Okay, it measure first method we have output method. Okay, output method measure progress based on the value of goods, value of goods, services transferred to the customer. For example, Uh, okay, for example, verb satisfied, surveys of performance, milestones achieved, appraisal results, uh, units produced or delivered, time elapsed. So output method is what has been delivered to the customer, and the selected output must appropriately represents the entity's performance towards completion. What's the limitation of it? Suitable output measures may not always be available or directly observable, right? Then next method is input method. Okay. So measures progress based on the inputs, efforts used to satisfy the performance obligation, compared with total expected units. Example, costs incurred, labor hours worked, resources consumed, and time elapsed, time lapsed, right? So input method is equal to how much effort, resources have been used. Okay. So if input methods are consumed evenly throughout the performance period, revenue can be recognized on a straight line basis. Okay, here we go. We have an example of a health club. Okay, so here, annual contract provides unlimited access for $75 per month. So in that case, customer receives benefits evenly throughout the year, right? Receive benefits evenly throughout the year. So performance obligation satisfied over time. Time lapse is an appropriate measure of progress. Revenue is $75 per month. So remember that output is equal to value delivered and input is equal to efforts or the resources used, right? Output is equal to value delivered and input is equal to effort, or what can you say, resources used. And if revenue, sorry, if performance occurs evenly over time, revenue straight line basis. So far, so good. I hope it is clear till here. Now we will do another activity, activity three now. So now we have an activity three. Mr. T is building a multi-unit residential complex. In the prior year, Mr. T entered into a contract with a customer for a specific unit that has that was under construction, Mr. T has determined that contract is a single performance obligation unsatisfied over time. Mr. T gathered the following information for the contract during the year ended 31st December, cost incurred to date, future expected cost, work satisfied to date, expected sales value, revenue recognized in earlier period required. Calculate the revenue to be included in the statement of profit or loss for the year ended 31st December during the following using the following to determine stage of completion, work satisfied, an output method, the basis of cost incurred, input method. Okay, so now here we go. Firstly, progress towards completion, work certified basis is 1800 divided by 3200, we get 56.25%. So revenue for the year, work certified basis, cumulative 3200 multiplied by 56.25% will get 1800. Prior year it was 1200. So this year it is current year 600, right? Now, as far as just second, uh, cost incurred basis, 1500 divided by 2500 is 60%. So cost incurred basis, cumulative 3200 into 60%, we get 1920. Prior year 1200, current year 720. So revenue recognized at the end of the first year is assumed to be the same using both uh, methods for simplicity. In practice, this is unlikely to be the case. Okay, so far so good. Uh, so I hope it is clear. It is clear till here. Now we will look at to cost to fulfill a contract. Cost to fulfill a contract. So costs incurred to fulfill a contract are treated as follows. Incurred to fulfill a contract are treated as follows. If covered by another IAS or IFRS, apply that particular standard. For example, example IAS 2, inventories, IAS 16, property, plant, and equipment, and IAS 38, intangible assets. Right? What I just said that if covered by another IAS, IFRS, apply that standard simply. Okay, no hard and fast rule over here. And yeah, but if not covered by another standard, qualifying direct fulfillment cost, may be recognized as an asset under IFRS 15. Okay. Now, what are the examples of direct fulfillment costs? Direct labor, direct material, uh, direct attributable cost, such as contract management, insurance, and depreciation. Another example is costs explicitly chargeable to the customer. Payments to subcontractors. Now, which cost will be expensed immediately? Okay. Uh, Cost expense immediately are, you know, uh, general and admin cost, administrative cost, wasted materials, labor, or other resources, or other resources that were not reflected in the contract price, and other costs that are not reflected for asset recognition. For sorry, for asset recognition. So I hope again it is clear till here, and overall you understand the things is still over here. Now what we will do, we will look at the another activity now. Okay. So here it is, activity number 4. Jackson enters into a contract with a customer to transfer a software license, perform installation, and provide software update and technical support for 3 years. Okay. To fulfill the technical support service of the project, Jackson purchased an additional workstation for the exclusive use of the technical support team for 9,000 and assigns an employee to be uh, primarily responsible for providing a technical support to customer This employee also provides services to other customers. The employee is paid on annual salary of 60,000 and is expected to spend 20% of his time supporting this customer. Requirement is explain the cost incurred in fulfilling the technical support service, right? So what is the additional workstation? Sorry, just a second. Additional workstation should be classified as property plant equipment. However, depreciation of this equipment will be included in costs that relate directly to the contract, assuming a useful life of 3 years. And no residual value. That would be hmm, 9,000 into 1 divided by 3 will get $3,000, right? So a proportion of the cost of the employee assigned to providing technical support should also be included. In this case, $60,000 multiplied with 20% will get $12,000 for each of 3 years. Okay, so far so good, and I hope it is clear till here. Uh, Now we will look at loss making, or you can say onerous contracts. Okay, onerous contracts. Well, onerous contracts uh, It is a loss-making contract. Okay. Uh, a contract is loss-making when expected cost to fulfill contract is greater than transaction price. Okay. So always determine whether the contract is profitable or loss making before applying IFRS 15 accounting requirements, right? So what is the accounting treatment over here? Accounting treatment for onerous contract. First thing first, revenue recognized at point in time. Okay. Oh, just second. Revenue recognized at point in time. That means revenue and costs, revenue and related costs are recognized at the same time. And the full loss is recognized when revenue is recognized. Bingo. Then, in case of revenue recognized over time, hmm, you have IFRS 15 may result in only part of the total loss in only part of the total cost, total cost, total loss, not cost, loss, total loss. Okay. Total loss being recognized initially. And then a provision for the remaining expected loss for the remaining expected loss is recognized under IAS 37. Okay. This, for example, here we go. Let us discuss example for it. Well, contract price 5 million dollars. Total cost, let's say $5.3 million. So total expected loss in this case, 5 million minus 5.3 million will get 0.3 million loss. Okay. Uh, During 2000X5, revenue recognized is dollar 2.9 million. 2.9 million costs incurred, 3 million. So 2.9 million minus 3 million is equal to 0.1 million loss, right? Remaining expected loss is $0.3 million minus $0.1 million is equal to $0.2 million. Therefore, $0.2 million provision is required under IS 37, right? So total expected loss is equal to transaction price minus expected total cost for an overtime contract loss recognized to date plus IS 37 provision is equal to total expected loss, right? And I hope it's clear till here to you guys. Uh, Now let us look at performance to a So, what will be the facts on statements of financial position? Okay. Um, well, in case of entity performance is equal to customer payment. See, there will be in that case there will be no contract asset or liability. In that case, there is no contract asset or liability. Okay. Then if entity has performed more than customer paid, it will be contract asset or receivable. And then if customer has paid more than entity has performed, it will be contract liability. Right? I hope it is clear till here. Okay, contract asset. Assets, it arises when the entity has performed, but its right to consideration, right to consideration is still conditional on something other than passage of time. Performance is greater than payment is contract asset. What is contract liability? It arises when the customer has paid when the customer has paid or or the payment is due before the entity transfers. Goods or services. That means payments are greater than performance is contract liability. So when dealing with the question of either contract asset or liability, think of the timing difference between the entity's performance and customers' payment. Entity ahead is asset, contract ahead, it is liability. Okay, so far, so good. Uh, right. So far, trade receivables arises when the entity has an unconditional right to consideration and only the passage of time is required before payment is due. Uh, for example, if customer has been invoiced, it is trade receivables. Trade is what is contract asset. Contract asset arises when revenue has been recognized, but the right to consideration is conditional on something other than passage of time. And what is contract liability? It arises when the amount invoiced or the received exceeds revenue recognized. Okay. I hope so far so good. It is clear to you all. And now, next, what we will look at. Let us look at the example. For example, contract price is $350,000. Excavated delivered is 1st April. Payment due in advance. For example, 1st September, sorry, 1st February, amount become due. So what we will do, receivable debit, $350,000, and contract liability credit, $350,000. 1st March, cash received. So cash debit, $350,000, and receivable credit, $350,000, $350,000. Okay. 1st April, excavator delivered. Uh, contract liability debit, and $350,000. Payment or invoice before performance is contract liability. So what I just say, payment, invoice before performance, contract liability. Okay. Next, one more example we have. Two excavators multiplied by $350,000. We get it's $700,000, right? So the payment for first excavator is conditional on the delivery of the second and therefore cannot be invoiced until 1st June. Okay. Payment for first excavator is conditional on delivery of the second and cannot be invoiced until 1st June. So first Feb, first excavator delivered. So revenue is recognized, but there is no condition, unconditional right to payment. But no unconditional right to payment. Contract asset, debit, 350,000, and revenue credit, $350,000. First June, second excavator delivered now. So the right to consideration is now unconditional and customer can be invoiced. In that case, receivable debit 7,000, contract contract asset credit 350,000, and revenue credit 350,000. So thing like this, the revenue recognized, is it invoice? Is the cash received? The revenue, but not invoice, contract asset. Invoice, but not paid, trade receivable. Invoice paid before revenue, contract liability. Okay. See, revenue recognized, invoice, cash received. If revenue but not invoiced, contract asset. Invoice but not paid, trade receivable. Invoice but before revenue, paid before revenue, contract liability. So contract asset is not is equal to a receivable. A contract asset is conditional while a receivable is unconditional. So far, so good. I hope it's all clear till here. Right now, we will do another example. So, falling from activity three, the contract is expected to complete, and the customer has end of each of the first 2 years and the balance on completion. Okay, the customer paid the first two installments. The customer paid first two installments when they fell due. The requirement is determine the figures to be included in the statement of financial position at the end of the first and second year. Okay, so firstly, end of first year, revenue recognized to date 1,200 less amount invoiced $1,000. Contract asset, 200. End of second year, revenue recognized to date, $1,800. Less amounts invoice, $2,000. You get contract liability, that is 200. Well, it is clear till here, right? Now let us move on further in the standard. Now let us look at what is repurchase agreements. A repurchase agreement occurs when an entity transfers an asset to a customer, but also as an obligation, but also has an obligation or option to repurchase it later, right? In this case, the customer does not obtain control of the asset. Well, accounting depends on the repurchase price, right? Let's say accounting depends on repurchase price. Okay. Well, repurchase price and treatment. Okay. Repurchase price, if it's less than original selling price, treatment is similar to lease. If it's equal to or greater than or greater than original selling price, it's financing arrangement. Next, let us look at the financing arrangement. When the agreement is a financing arrangement, financing arrangement, asset remains recognized by the seller. Asset remain recognized by a seller. Cash received is recognized as financial liability, is recognized as financial liability. No difference between cash received and repurchase amount. Cash received and repurchase amount is recognized as interest expense. And lastly, no revenue is recognized initially. Okay. For example, original selling price $350,000, repurchase price $385,000. Because the repurchase is greater than the original selling price, this is financing arrangement. Okay. Uh, repurchase greater than selling price. It's financing arrangement. Cash debit 350,000. Financial liability credit 350,000. During the year, interest expense $385,000 minus $350,000 is $35,000. Interest expense debit 355 35,000. Financial liability credit 35,000. Remember, interest expense is presented in financing category of profit or loss. 31st December, option lapse. The repurchase option lapse unexercised. Well, in that case, financial liability debit 385,000 and revenue credit 385,000. So the asset is effectively sold at this point. Repurchase obligation customer does not obtain control. Repurchasing selling price is greater than lease repurchase price. is greater than or equal to selling price. It's financing. For a financing arrangement, no initial revenue liability, then interest and revenue when repurchase right expires. So far, so good. And now, what we will do, we will look at bill and hold arrangements. Bill and hold arrangement. Now, what's that? Bill and hold arrangement occurs when an entity bills the customer for a product but retains physical possession of the product. So revenue is recognized only when the customer obtains control, even if the product has not yet been physically delivered. When can control transfer without physical delivery? Question is, when can control transfer without physical delivery? For this case, all four criteria must be satisfied. Uh, Number one, substantive reason for the arrangement. For the arrangement, for example, customer lacks the storage. Product is separately identifiable as belonging to the customer. Identifiable as belonging to customer. Product is ready for immediate transfer, entity cannot use, redirect the product to another customer. So that means all four criteria meets, control transferred, revenue recognized. So contract, includes excavators, spare parts, custodial storage services, right? And I hope it is clear till here. Next, we have consignment arrangement, and next we have consignment arrangement. In this case, when goods are delivered to a dealer, and the goods are delivered to a dealer, distributor, for onward sale, determine whether control has transferred, control has transferred. For example, let us look at like this: arrangement, control, and revenue recognition. So, in case of a sale, dealer obtains control, right? When goods are shipped, or what we said, delivered. Consignment, when entity retain control. Okay. Uh, recognize when dealer sells to end customer. And customers or obtains control. Now, what are the indicators of consignment? A consignment arrangement is likely when entity retains control until a specified event occurs, until specified event occurs. One, two. Entity can require return or transfer, can require return or transfer of the goods to another party. Dealer does not have an unconditional obligation to pay for goods. So, in case of consignment, no revenue when goods are delivered to dealer. For example, a car delivers cars to a dealer. Legal title passes only when sold to the public. Dealer pays only when and legal title passes. So a company can require cars to return or transfer to another dealer. It's a consignment arrangement, and dealer has not obtained control. Therefore, revenue can, when cars are delivered to the dealer, revenue is recognized when the dealer sells the car to the customer. Can the dealer return the goods and avoid paying until they are sold? So in the if yes, it's likely a consignment, no revenue. on delivery to dealer, control retained by manufacturer, revenue delayed until control passes away. And I hope it is clear to you guys. We are done with the IFRS 15 uh, revenue from contract with customers overall. Uh, See you next time. Till then, take care. Bye bye.